Hello everyone, welcome to my YouTube channel and welcome to the weekend analysis video. So let's talk about the markets. This week was a very short week because the Friday session was closed on account of Good Friday. So we had 4 trading sessions starting from Monday to Thursday. Now, if we recap, what happened exactly is just after Powell's speech last week, we had a massive gap up and we touched the all-time highs. And since then, we just kept on consolidating and we just kept on digesting the gains, not coming drastically down and not going drastically up. So this is very normal behavior of the markets. Like whenever we go to all-time highs or whenever we have a huge gap up opening, then we tend to digest for a certain number of days, let's say 2, 3, in this case 4 days. So it was a perfectly natural day where we were bouncing off 5-day EMA. So this is the theme of the markets. Right now, they are consolidating and digesting the amazing run that we have had over past several months. So let us dive deep into the analysis and let us discuss the important levels. Starting with the macroeconomic analysis. In this section, as always, I want to discuss some important economic events and some driving forces which can have a meaningful impact in the next month's price action. So what happened this week was, at the start of this week, it was an unfortunate accident that a container ship, that is a cargo ship, was responsible for entirely bringing down the bridge in the Baltimore port. Now, when I did some research digging deep into this situation, it appears that this port is one of the most important ports in the East Coast. So the problem is now all the cargo ships that are currently on that port, and which includes also some passenger ships like cruise ships, they are locked essentially. So by the time the cruise ship or the container ship is got rid, and by the time the bridge remains are handled properly, the entire cargo is locked. So you may say that we have several different ports and why are we discussing this? The reason we are discussing this is because supply chain still remains very important in terms of logistics. So this can put a reasonable or meaningful upward propulsion in terms of goods and services prices, because remember, we are still at war on inflation. So if inflation for some reason doesn't come down, then that is not going to be a good news for the markets. So that is one situation over here. According to my experience, this is not going to be a make or break situation, but I just wanted to bring this into your notice that anything in the world can and will affect financial markets, and we as financial participants are supposed to know and gauge the impact of those events. So that is the Baltimore port situation from my lenses. So this next point that I wanted to discuss is the divergence between the 2-year bonds and the 10-year bonds. So there is a 40 basis points difference, that is 0.4% difference between the 2-year yield and the 10-year yield. Now this is not good, because when the short-term bonds are giving you more than the long-term bonds, then the yield curve inversion is very intact. So I don't know for how long the yield curve will be inverted, but as the past data suggests that this yield curve inversion has and probabilistically speaking will bring a recession. So that is one thing to note, that the bond market situation right now is not looking good. The third point that I wanted to discuss is we have crude oil situation. So you can see that the crude oil is sitting at $83 per barrel, which is putting upward propulsion or upward force on the goods prices. So if this crude oil level be here for a sustained period of time, that is more than $80, then the inflation forces are still going to be upsurging. So that is something that we really need to bake in to the price, because the problem is if the crude oil price is related to all the goods and services and whatnot, so the sustained higher prices in crude will result in the sustained higher prices of goods and services. So that's one key observation. Another key observation is in spite of the markets sitting at all-time highs, the commodities like gold, like silver, they are firing up like crazy, and they are also hitting new highs. So when the investor money is, making its way through to commodities, and when gold is firing up, that means, people are running for safety. And so that is, I don't take this as a, symbol of, okay, a big major crash is coming. But what I'm saying is, we need to be aware of these, signs of warning. So that's on the commodity side. The third is, US 15-year and 30 years fixed mortgage rates. So this is something that all the, retail people like you and me will be really concerned about. And the reason is, let's say you want to buy a house, or you are in a position of planning to buy a new house. The mortgage rate right now is sitting at 6.79% for 30 years fixed, and at 6.11% at 15 years fixed. So historically, if you look at these rates, these are, very high rates as far as, home loans are concerned. So if, let's say, I want to buy a house, and if I go with these rates, then understand that my purchasing power or my disposable dollars will reduce in other spending, because I'm spending much more in housing. So if that spending goes down, American economy is very, very, dependent on consumer spending. So if consumer spending has these risks, then, the earnings will be impacted. And remember, we will have, earnings season, let's say in 1 or 2 months for the big tech. So I just wanted to bring all these points into your mind, and wanted to discuss the macroeconomic trends so that we are well aware of, and on top of it, to make things even worse, we are sitting at all-time highs, and we haven't seen, a meaningful 5 to 10% correction since, let's say, 6 to 7 months. So the last time we saw a meaningful correction was in October of 2023, and since then we haven't seen 8 to 10% correction or a pullback. So yeah, that's the correlation of price action and macroeconomic trends. So that's my take on the current state of markets from a fundamental and macro point of view. And now let us jump right into the technical aspects of it, so that we can know the exact levels to expect and the exact levels to trade from. So let's jump on to the weekly time frame. If I talk about weekly time frame, as always, I will discuss the support levels, the resistance levels, and some important points related to the weekly charts. So let me open the weekly charts and exactly show you what I mean over here. So these are the weekly charts. And as you can see over here, one key observation is we are consolidating at the 1.272 Fibonacci ratio level. So where does this level come from? So as you can see, I have plotted a Fibonacci, ratio from the highs of 2021 to the lows of 2022. And then on the weekly time frame, I'm just looking at key levels, that is the golden ratio level. So as you can see, since past 4 to 5 weeks, we are just consolidating and getting rejected from the 1.272 level, that is this one. So going forward, what is the resistance level? The resistance at the weekly time frame is sitting at the top of the Bollinger Band, that is 19,000 levels, and 19,000 also happens to be the psychological level of resistance. So that is from the resistance front. What is on the support front? The support front, you can see over here, the simple blue line that is over here in the green support zone, that is 5-day EMA. So on the weekly charts, this 5-day EMA would be the first line of defense, and also it coincides with all the POCs that you can see over here. Now, what do I mean by POCs? That is the point of contact. In technical terms, if you see this 1, 2, 3, 4 candle over here, the maximum volume that has occurred in this area, that is over here, this cyan or light blue line that you see over here on each candle shows the maximum amount of volume has occurred in these levels. So there is a very high possibility that the markets will come at these levels to grab the liquidity and then move forward if they want to move forward. But the higher probability case over here is to come at these price levels and then push forward. So what is this green zone? I have drawn this green zone because we have consolidated in this zone for almost 1, 2, 3, 4, 5 weeks. So this level corresponds to the price level of 18,300 on the Nasdaq futures, and the ultimate support is still sitting at the year-to-date anchored VWAP, that is 17,744 level. So So this is, weekly charts, nothing, astounding or no divergences or no surprises over here. We are just consolidating at an important fib ratio, and that is the takeaway from the weekly time frame. Now, let us go to the daily time frame to actually analyze in detail what is going on under the daily time frame. Now, let us discuss the daily time frame. And I love daily time frame because of exactly what is going on in the markets right now. There are times in the markets when a specific time frame gives you a very good idea of what is happening underneath or under the hood. So in daily time frame, not only am I going to discuss the resistance level and support level, I'm also going to show you some confirmatory signals that we can use to actually affirm our thesis on the trend and on the momentum. So without further ado, let me go into the charts and show you what I mean. So this, as you can see, is the daily charts. Now let us discuss first the support levels. So as you can see, the support level on the daily time frame, the immediate support level is sitting at 13-day EMA. That is this green line that you see. And this green line also coincides with the R1 pivot level. So in technical analysis, the previous resistance becomes support. That is the concept of polarity. So the R1 right now, it will act as a support as opposed to the resistance. So if the markets decide to pull back, then the first line of defense as support is going to be this one, that is 18,400 levels around. And if the market, really decides to pull back stronger, then the actual, ultimate term support is going to be this anchored VWAP, that is 18,300 levels, and this 26-day EMA, that is 18,240 levels. Now, for Nasdaq contracts, according to my experience, for Nasdaq contracts to have a 1 or 2% day is very, very natural. So the problem is, if we have a 2% day, then you can see over here, the 2% is, too much. It goes all the way back to 18,100 levels. So do not be surprised if we get a catalyst that can bring the markets down by 2%, because for Nasdaq contracts, as I said, 2% days are very, very, natural. Now, given that next week we have Fed Chair Powell's speech, we have non-farm payrolls data released on Friday. So given that we have, good high catalyst events, you have to be prepared for both the short side and for the long side. So I just wanted to, point it out that, don't be, misled by the indicators, because if the Nasdaq decides to pull back for, let's say, 1 or 2%, then all of these support levels get devastated. So just a small disclaimer before you go into the trading session of next week. Now let us discuss the areas of resistance on the daily time frame. When I talk about the area of resistance, according to the price action, I have drawn this box, which is the zone corresponding to the rejection area of lot of candles. So as you can see over here, we got rejected on this day, same happened this day, same happened this day. So this zone has been tested a lot of times, and it has been acting as a resistance zone a lot of times. So if the markets decide to go up, then the first level of resistance zone is going to be this level, that is 18,600 levels. And if it devastates this level, then the next level of resistance is going to be R2, and the ultimate area of resistance is going to be the top of the Bollinger Band on the daily time frame. Now so this is the meat of the game, because I wanted to show you the trend. Make no mistake, the uptrend is still intact, and let me show you why. For any trend to be negate itself, it has to go down more than the golden ratio of Fibonacci level. So what do I mean over here? This was the most recent pullback, that is the most recent lows. So let us draw a Fibonacci ratio from here to the most recent high, that is here. Now, as you can see, we have not even breached 0.5 ratio of the Fibonacci level. The trend can only be negated if we close on a daily time frame below the 0.618 level, that is the golden ratio level. If we close below this level, only then we can have a conclusively high probability bet that we have reversed the trend, the markets are going to reverse, and only then we can have a conversation about markets going down. So as of the time of this recording, and as of right now, markets trend, that is uptrend, is still intact. So make no mistake on that front. So that is the daily time frame level from a technical view, from a trend view. And right now, as you can see, after the Powell speech, that is on this day, 20th March, we had a massive gap up. We got rejected on the R2 pivot level, and then from that day we are just consolidating. So as you can see over here, we are just going sideways, going chop, and we are just consolidating over here. So this consolidation is very, very healthy. It happens in the markets, and it should happen because these large gains need to get digested for the markets to go even upwards higher. So this is pretty healthy price action. We also filled a lot of gaps for these kind of days in the futures market. So rest of all, I don't see a very bad action in terms of shorting. So all I see is a normal uptrend grinding higher. Yes, you can argue that the volatility is going down like crazy. We are not getting 2 to 3% days very frequently. That is true, but same is true for the economy as well. If we don't get unknown shocks, then this is going to be the theme of the markets, going and grinding slightly higher. So that's the take on the daily time frame, and make a note of these important levels. We are coming to the close of the month, so the month to date anchored VWAP and the pivot levels are going to get renewed, so make a note of that as well. So this is my take on the daily time frame. So we discussed various time frames like weekly time frames, daily time frames, and one important question that we need to answer is who is in control, who is dominant in the short term and who is dominant in the long term, so as to gauge a fair idea about the bulls and bears action. So the best indicator that I have come across is anchored VWAP, which tells you that who is in control right now in a given specific time frame. So let me show you the short term scenario and the long term scenario in terms of daily time frame, and let me show you who is dominant right now. So if I go to my anchored VWAP charts, that is this one. So in these anchored VWAP charts, I have mounted each of the anchored VWAP to a specific point on the chart, which is of significance in any event. So over here, I have mounted this on the most recent high. Over here, I have mounted it on a contract switch. Over here, the yellow VWAP I have mounted on the exact intraday time frame when Powell started speaking. So in the short term, it looks as if the bears are in control. The bears are dominant in short term. The reason is very simple. The reason is we have closed below both the anchors, the most recent high anchor and the FOMC anchor, that is yellow line and blue line over here. So apparently as of the close of Thursday's trading session, the bears are in control in a very short term. But on the contrary, look at what is happening on the long term. So if you look at the long term, that is month to date anchored VWAP, that is this blue line, and the green line, which corresponds to the Nvidia earnings, what is happening is we are still above these two lines, that is the long-term anchors. So as long as we are above this long-term anchors, the bulls are very much in control as of now. And regarding the short-term bears control, I can assure you that one day of 0.5% or 50 basis points of upwards day can negate this entire scenario. So keep a close eye on these levels. That is the most recent high, the FOMC anchor, and the medium term anchors like these, that is month to date anchor. Why am I telling you this? It is because these are the definitive levels to which, based on volume, you can expect the markets to go down to these levels. So for example, let's say if markets go down, then the very strong line of support is going to be this green line, that is the anchor that I have mounted on Nvidia earnings over here. So this is the anchored VWAP, and the objective of me showing you this chart is to show you who is in control over the short term and who is in control over the long term. So this is what I draw my conclusions from, the anchored VWAP charts. Now, let me go into the future, that is next week's big catalyst and next week's strategy. For the next week, the two things that I want you guys to be aware of is these. First is on Wednesday, we will be getting a Fed Chair Powell speech and the release of FOMC minute meetings. So the FOMC minutes is going to be, very, very important for, the markets moving forward. Also, there will be a non-farm payrolls data release on the Friday in the pre-market hours. So these two, events are going to be crucial for the markets moving forward, because a lot of Fed speakers are going to speak on the next week. There is also ISM, manufacturing data that will be coming out. So remember that this is the first week of April that we are talking about, and the next week of April, that is the second week of April, we are going to have crucial CPI data release. So as far as price action is concerned, I don't see a major, change change in the price action before the incoming CPI data. But still, since we have the first Friday of the month, that is non-farm payrolls data release, they expect a lot of 1 or 1.5% days in terms of the rate of change, that is delta. So going forward next week, I would be very interested in trading full size on Monday and Tuesday, and I would wait for Wednesday to downsize and to hedge my risk. Moving forward on the Friday, I would be very cautious because of the release of the non-farm payroll data, and the Monday is going to be very stable, and because markets are actually waiting in the anticipation of the FOMC minutes and the remarks from Fed Chair Powell. He did speak to the on the Friday, the Federal Reserve Bank of San Francisco, in a 1 hour long interview, and he did reaffirm his resolve to bring inflation down to 2% target. Now he wants more data that can give the Federal Reserve the confidence to move ahead and do the rate cuts. So as far as I'm concerned, what I see in the markets is a sustained sticky inflation of 3 to 3.2%. And since we had crude oil rising, I don't see a very big incentive for the Fed to cut the rates very soon, because as reinstated by the Fed Chair Jerome Powell in his interview, he said that the risk of cutting too early is more than the risk of cutting late. So the economy is firing up on all cylinders in terms of GDP, in terms of productivity. So right now, Fed has very little incentive to do the cuts. If you see the CME Fed Watch tool, even that is not suggesting very big rate cuts. So we'll have to see and watch and observe how the economy unfolds and how these events take place. But one thing is for sure, on the backdrop of strong economy, the Fed will not be forced to do the rate cuts. And also the interviewer of the Federal Reserve Bank of San Francisco asked Powell yesterday that the Fed is an apolitical organization, so it has no impact, or their decision making doesn't get impacted from the politics, since this is an election year. So I would believe in the full faith of Fed Chair that they are not being influenced by politicians. But let's be real, in any election year, you won't see a drastic, harsh decisions from Federal Reserve. So even if the rate cuts happen, how deep those cuts will be is a real question. Because if the rate cut happens just 25 to 50 basis points, or let's say 1 or 2%, that is not going to, be a very meaningful impact. So he did reaffirm that he doesn't think that it is going to be like your previous times, that is zero interest rate environments, because that is going to, that is a very unrealistic scenario. So expect higher for longer, expect the rates to, not go back to the pre-pandemic levels. So yeah, this is a tug of war, and yeah, brace for the impacts, and be habitual to the higher prices. And yeah, markets, as far as I think, is going to go very slowly higher. So it's going to be a lot of chop, and there you have it. So last but not the least, I would like to thank you for viewing, and really appreciate if you can like, share and subscribe. And thank you for taking 20 to 30 minutes of your time to actually view this video every weekend. And I hope that I'm providing a lot of value and a lot of knowledge which will enable you to have taking a better decisions and being a better informed market participants. So as I always say, keep your perspectives open, keep learning, keep growing, and keep trading. Thank you guys, and I'll see you in the next video.